Okay, think of the greatest investors in the history of the world, really. Think of, Warren Buffett, Peter Lynch, Peter Thiel, Jacob Astor. Think of Benjamin Graham, Andrew Sirius, Philip Sirius. By the way, we're Andrew and Philip Sirius, we're the Sirius brothers. And
greatest investors of all time as well.
Greatest investors. And what you notice is that time in the market beats timing the market. These
Always.
are long-term investors looking at deal. They are getting in and they are staying for the long haul because things go exponentially. You go a little bit here does not equal a little bit in a sort of exponential pattern. So like you have a company, you buy an Apple, and it goes up 5%, and you get out. That's great. But if you bought it, 10 years ago, I don't even know how much money you made. A lot. It's gone up from to 5 to 200 and split 7-8 times in the midst of that. So, yeah, time in the market beats time in the market.
Now, I think all these investors are generally the greatest of all time. There's one I think that we're missing, is Michael Burry, who is the only one I know of who's a little bit more on the speculation side, who has done really well. He was in The Big Short. He was, what's his name? Michael Scott's character.
Oh, yes, Michael Scott.
I'm just helping you invest in your future, my friend.
It sounds like a get-rich-quick scheme.
Yes, thank you. You will get rich quick. We all will.
Steve Carell's character in The Big Short, and he predicted the housing market crash. He got into GameStop pretty early, so he's very much more on a short timescale stuff. But he's the only one I know who's done this really well.
There are certainly people who have made huge amounts of money timing the market, buying right before, shorting right before. There are the quant funds like Renaissance who trading currencies in and out in a day or something like that, but the greatest are almost uniformly long-term buy and hold guys.
Well, and if you do something like Michael Burry, you're always gonna have some regret, and you're never gonna be able to hit it perfectly. Like I mentioned, he got the GameStop thing right. That happened. He bought it, I don't know, $3 or $4 a share. He bought his biggest holding at one point. Yeah. Then everybody was confused because he got super mad when the whole short squeeze thing happened, and then everybody came to realize when his reports came out, he had sold at $25 a share or something like that. So if you're playing a speculation game, you have to also time it perfectly. I mean, you're always going to have regret.
I had the idea of buying Bitcoin when it was under $1, but I thought of it as a currency. I didn't think of it as an investment, so I didn't go through with it, and I have had regret about that. At the same time, I would have sold it or sold most of it.
Yeah.
But Satoshi Nakamoto has held on to how many coins does he have right now? He's worth $60 billion even after the things went down. So
if he's a real person.
Not a group. But it's time. Yeah, we should add him to the list of greatest investors by investing.
He didn't invest. He created. Okay. He's an inventor, not an
investor. Yes.
Yeah. But so if you're looking at this in terms of speculating, trying to time things, trying to not get in the market until it's really low, trying to make sure to sell at the top, you're never gonna be able to sell at the tippy top. You're always gonna miss that.
You're not as good as Peter Schiff. He called the housing crash. He wrote a book on it, and he lost almost. And his fund went down almost 50%.
Yeah,
he put it all in gold and stuff like that. It's you can even call the market right and still miss.
Even if you do time it right and put in all your money at the bottom, you're always gonna go I should have bought more. People with Bitcoin and stuff it's always when it goes up, you're I should have bought more, and when it goes down, it's I should have sold at the top. You can never quite predict this. The market can stay irrational longer than you can stay solid. Yeah, you're not going to get this stuff right.
We have a friend who bought Dogecoin at 3 cents, and the first thing he was talking about is why I shouldn't have bought it at less than 1 cent.
Yeah. So if you're going to not try to exactly time the market, what is the strategy you should do? Just buy all the time, or what should you do?
Dollar cost averaging. That's a great way. A great first thought process. When the market goes up, you buy a little bit less because you're buying the same amount, but you're looking. Benjamin Graham, value investing.
Yes.
The intelligent investor, you're looking for good deals, and that means it doesn't mean you don't take the market into account. It doesn't this market feels like we're at the top. We've been on one of the most ridiculous real estate runs of all time. The stock market's hitting record highs, even though the economy is sluggish. It seems like it's a bubble. So you should be more cautious. I would openly state, be more cautious.
Although I don't think it's a bubble, but I still say be more cautious.
Don't reach. At the same time, we're probably going into a stagflationary environment. We're going to have higher inflation, which is hey, if you sit on the sideline with your money in a CD, oh, you're losing money, by the way. So
Well,
there's no safe harbor anymore.
Holding money is an investment in the dollar.
And the
sense.
dollar is not a good investment. No. So, I mean, you don't want to reach. There's definitely a chance that the market, I think, will at least correct, slow down for sure. I don't think it's going to crash, but I do think it will correct a bit. You think it's probably just going to, whatever, different video. But the main thing is, don't reach. Be careful. Make sure you're getting a good deal, but buy value. And if you're flipping, you're adding value. You're doing a completely different type of transaction. You're not going in and out.
Yeah.
Buy for the long run. If it corrects, people who bought in 2006 did perfectly fine as long as they were able to stay solvent, as long as they were able to rent it. Now the market has well gone past that. Time in the market be
and to bring it to real estate, kind of our area of expertise in a sense, we're not looking to just buy real estate or tell you just buy real estate. Buy really good deals in real estate.
Yeah.
Or if you're doing stocks, buy something that's really good deals in stocks. If you're buying cryptocurrency, it's a speculation because there's no inherent value to it.
Bitcoin cannot be stopped. Bitcoin is going to $100,000, and why Bitcoin in the long term is going to be worth more than $1 million per coin.
You're willing to use money that you're willing to lose. Although it can, you definitely can make money.
You can make money with speculation. Just understand it's not investing. And so real estate, insulate yourself from being in a bubble by buying something that's under market value that you can create value from by improving it in some way.
Don't reach. Don't feel like you have to buy. Don't be a motivated buyer. If you're in the market and you can't find a deal for a couple of months, don't feel bad about it. But don't sit on the sidelines. I have a friend who he bought his home. He bought a second house in 2015. He's like, you know what? I'm gonna wait for the market to correct. And he's still waiting. There's a lot of people. That's a very common story because I kind of felt like the market was going to correct in 2018. And here we are in 2021. No correction. No corrections happened. So keep looking for good deals. Don't reach, but don't sit on the sideline. I ran an analysis of what it would be if you just bought a house for a $100,000 house. You put $25,000 down. You had a $75,000 loan. 20-year amortization. You made absolutely nothing. You broke even. So the rent just paid for the mortgage, the taxes, and the insurance, and the property didn't appreciate at all. 0% appreciation, but you paid the loan all the way down to zero. So you made $75,000 over 20 years with your $25,000 investment. Your rate of return is 5.65%. Now that's not.
It's more of a forced savings.
Yeah, it's forced savings, but it's not incredible. It's not record breaking, and of course it wouldn't be that if you sold after 5 years because an amortization chart, you pay more principal down near the end of the loan than at the beginning. So there's all that to take into account.
You also get depreciation if you're an active.
But you're not taking account of any of the other benefits. You're not taking account of depreciation on the tax benefit. Video on that on there. You're not taking the zero positive cash flow, and we recommend with the large majority of your investments making sure you have positive. You can have a small bit for speculation. Just like you can have a small bit to speculate on cryptocurrencies and stuff like that, but the majority of it should be on cash. The large majority of it should be on cash flowing items, and no appreciation over 20 years. That's never happened in American history.
Also, not buying a property that has equity in it once you buy it and you fix it up.
All the advantages, the ideal income, depreciation, equity buildup, appreciation, and leverage, as well as buying good deals right up front. We've done videos on why buy and hold so great. All that, by the way, is all just equity buildup over 20 years. 5.65%, much better than a CD, much better than, not as good as the stock market on average, but just like if you sit on the sideline for a couple of years, that's 5.65%. You're missing money, especially in the dollar, which is depreciating.
Well, that's the thing.
We have inflation.
Think about it this way. You're not sitting on the sidelines because it's impossible. If you have wealth, your wealth is stored somewhere. You cannot sit on the sidelines. What you're doing is you're choosing to have your wealth in the asset of the dollar and saying the dollar is going to do well.
A CD.
So you're not on the sidelines. Wherever you are, you're not on the sidelines.
Or a CD or a money market. A saving account is 0.1%. A money market is 0.5%. And the stock market is, if the real estate's in a bubble, the stock market's in a bubble too. So, the lesson is simple. Time in the market beats timing the market. Don't sit on the sidelines.
Don't bet on the dollar versus
Don't reach.
Else.
Don't reach. Be careful. Make sure you're getting a good deal. But don't. The only people who sit on the sidelines are bench warmers.
And that's why we don't want you to sit on the sidelines. We want you to invest now into the subscribe button underneath this video. It's red. hit the subscribe button. We'd really appreciate it. Hit the like button, share the video, all the things. Definitely TikTok it and Snapchat it, because those are the social medias we're on all the time.
Do it.
And yeah, we appreciate you guys watching, and we'll see you on the next one.